Dear all, this is Güldem Atabay, an economist covering Turkish economy for a long time, a columnist at PATurkey, a part-time lecturer at the university. Today I want to speak about the central bank's rate hike that was not really. So, the Central Bank of Turkey met today, and with its Monetary Policy Council meeting, the bank decided to deliver a 200 basis point rate hike finally, and it elevated its policy rate from 8.25% to 10.25%. Along with that, the central bank's overnight lending rate was elevated by a similar amount, 200 basis points, to 11.75%, and its late liquidity window interest rate was also increased by another 200 basis points to 13.25%. So this sounds very good, given the Turkish lira's meltdown in the last 1.5 months especially. That adds to a mouthful 23% year to date against the US dollar. But it's been a little late and it's not good enough, because what the central bank has been doing so far is to refrain from increasing the policy rate. It has been changing or altering its routes of financing or giving liquidity to the market. It's been using the late liquidity window and overnight lending rate basically. And its average funding rate was already at around 10.62% as of yesterday. So the policy rate at 10.25% right now doesn't really make sense if the bank is not really going to be using the policy rate. If the bank is going to be using the policy rate, that means a reduction from the weighted average cost of funding from 10.6%. So this means that the central bank is either not really going to use the policy rate that it has elevated, it has increased today, or the bank will again use other routes, other channels to finance liquidity to the market, which means it will be using the 13.25%, 11.75%, which are basically the late liquidity window rate or the overnight lending rate. This doesn't really make sense when we consider that the Turkey's current headlines CPI inflation is already at 12%. Its core inflation is above 10%, which means that the central bank, given this late increase, is still lagging behind the real what's happening really in the markets, the rate of inflation. It's still imposing negative real rates. So that means the Turkish lira, the initial reaction might be seen as a rebound from the 7.7 levels that it's reached recently, the record low levels. It's improved from 7.7 to 7.58 levels, but that was kind of temporary, because now the market's focus will be on whether the central bank will be using this interest rate corridor in order to fund the market, and I think it will, and it means that it will eventually increase the effective funding rate from 10.6% to somewhere to between 11 to 13%. And given that Turkey's inflation is already at 12%, that's not really good enough. Which means that Turkish lira meltdown will continue in the days ahead. After the market watches how the central bank will be using its new funding rates. The inflation will be moving upwards again, given the TL meltdown recently, while the domestic demand is still very strong, thanks to all the liquidity pumped into the markets from all these cheap rates, relatively cheap rates, negative real rates, let's say, and all that which created hard currency demand from locals especially. And it has fueled inflation, as I said, the core inflation up above 10% levels. It has increased the import level, given that the tourism sector revenues are absent this year, almost absent this year, because of the COVID-19 pandemic situation. Turkey's current account deficit is already at around 4% of its GDP. None of the foreigners, almost zero, fund flows are coming into the markets and being observed in the balance of payments details. In fact, some 15 billion US dollars have left the Turkish market in terms of portfolio funding. There is no FDI coming in. The imports are higher, domestic demand is higher, inflation is higher, budget deficit is increasing, the government's debt level, especially in terms of hard currency, is increasing, and the central bank is just doing a 200 rate hike as of September this year. So what we'll see in the months ahead is that this will not be good enough for the markets. I think the central bank's weighted average funding rate will be elevated towards 13, 14, eventually 15% levels, which means that the inflation first will increase towards 13% and will come down to some 11-12% range. And unless the policy rate is escalated to, this will not have a very serious impact on the Turkish lira. And we'll still have the Turkish lira US dollar parity at around some 7.5 to 8 levels by the end of this year. And as for the rate of inflation, inevitably this 23% depreciation since the start of the year, combined with a very strong domestic demand, I think that has gone beyond what the recovery is calling for after the pandemic contraction. They are all combining to push up the inflation, along with the central banks, along with creating the central bank a necessity to increase the policy rate further. And this weighted average cost of borrowing, its escalation towards 14-15% levels, I don't think it will be good enough to stabilize the Turkish lira in the very near term. So what we're looking at is a kind of situation where the initial rebound from the pandemic contraction will be slowing down eventually, starting from the fourth quarter of the year. The rate hikes adding further momentum to the slowdown, and inflation remaining in double digits by the end of the year. The budget deficit to GDP ratio at around some 5 to 6%, up from 2.8% last year. And the current account deficit, excuse me, obviously coming from a surplus last year to around 1.5% of GDP, turning into a contraction or into negative levels at around 4 to 5% of GDP. So whether this will be enough for the Turkish markets to stabilize, to have its risk premium lowered down, it remains to be seen. But unless, or even if the government earns time through the actions of the central bank in terms of lira stabilization in the very short term, I don't think the president's wish to have lower rates and a very strong growth rate for Turkey will phase out in the coming year. So upon the first chance, after a couple of steps of elevating the policy rate, I think the Turkish administration, including the central bank, which is kind of directed by the president, I think rate cuts will be coming to the agenda as early as 2021, once we see some form of slowdown in the pace of inflation in Turkey. So this still is not a very good combination looking forward, when Turkey will have real struggles in terms of creating strong GDP growth in terms of what our president really wishes, at around 5 to 6% scheduled for next year. So rate hikes, today's rate hike I think will be followed by a couple of more rate hikes in the coming 2 to 3 months. And then a kind of stabilization period will be followed by another round of rate cuts. And sadly, the administration, the Erdogan government, the AKP's Erdogan government, I don't think they will be bringing forth or creating a new agenda in terms of reforming the Turkish melody structurally. So that's not a real good story where Turkey will be attractive enough to attract the much needed fund flows from abroad. Maybe the with the rate hikes, if followed by a few more steps, will be good enough for Turkey to attract a few more billions, which will be kind of pressuring down the external financing problem, or the many reports that's being issued recently about Turkey's external financing problems that's looming in the months ahead. But it will not be enough to change or reverse the general trends in the Turkish economy because of the way that it's being managed currently. Thank you for all your attention. We'll see you again. Bye-bye.